Price keeps hitting the same memory, but it cannot move free for long. The week forms around weekly 0.33 and old US boxes. This week is not a simple rally. It is not a clean sell-off. It is not one direction. It is a week where every session has to prove itself again. Price drops from compression. Then it fails to finish. Price launches from a lower base. Then the next entry never comes. Price stalls inside weekly 0.33. Then the short opens again. Price bounces into the same line. Then the final session has to be skipped. That is the week. If you only watch the candles, it looks confusing. If you watch the session boxes, the pressure becomes visible. If you watch the higher time frame first, the 1-hour chart becomes tradable. Before any live trade, the higher time frame must come first. Monthly, weekly, daily, then the 1-hour session. Especially the weekly chart. Do not start the week without it. The weekly chart stays in the background of every entry. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines are not background noise. They decide where distance can open. They decide where reaction speeds up. They decide where continuation fails earlier. This week, the 1-hour chart keeps using old US session memory. June 18th US memory. June 22nd US memory. July 3rd US memory. July 8th US memory. July 9th US memory. July 10th US memory. July 13th US memory. July 14th US memory. July 15th US memory. July 16th US memory. The market does not reset each day. One session forms. It leaves a box. The next session forms inside it, or at its boundary, or at the same line with weekly pressure. Then price reaches the line. It reacts. It holds or fails. That is where the trade begins. The method stays the same. Stop line first. Entry line second. Target line third. If the stop is unclear, no entry. If the entry line is not touched, no trade. If the target does not pay at least 1.5 risk-reward, no trade. If the session is the final US session of the week, the filter becomes even stricter. That matters this week, because the market gives both good trades and dangerous plans. July 12th Asia opens the week with compression. The session forms inside June 18th US memory. The box compresses about 50%. Price cannot hold the upper side. It breaks down. The short opens. Entry comes from July 12th Asia upper boundary. Stop sits at June 18th US upper boundary. Target moves toward July 9th US upper boundary. Trail moves toward July 9th US lower boundary. Risk-reward ratio reaches 4.28. That short works because compressed upper memory fails. Not because the candle is red. Not because price looks weak. The line fails. Distance opens. The trade earns execution. Then July 13th US gives friction. The session forms expanded inside July 3rd US memory. The short setup appears. Entry comes from July 13th US upper boundary. Stop sits at July 9th US upper boundary. Target sits at July 8th US lower boundary. Risk-reward ratio reaches 1.99, but price cannot reach the full target inside the session. Continuation slows. Distance becomes shorter. Reaction returns. The trade ends with small profit. That matters. A valid setup can still lose quality after entry. When the target does not arrive, the account protects. It does not beg. It does not freeze. It does not turn a small win into a loss. Then, July 13th, Asia changes the entire week. The session forms compressed inside July 8th US memory. Price holds the lower side. It launches. It breaks July 13th US upper memory. It breaks July 9th US upper memory. It moves toward June 18th US memory. The long opens. Entry comes from July 13th, Asia lower boundary. Stop sits at July 8th US lower boundary. Target moves toward June 19th US upper boundary. Then multiple trails appear. July 13th Asia upper boundary. July 13th US upper boundary. July 9th US upper boundary. June 18th US upper boundary. Risk-reward ratio reaches 9.25. That is the big moment. The move looks explosive, but it does not start at the top. It starts from the lower base. If you buy late, the trade is gone. If you chase after the green candle, the risk-reward dies. The trade pays because the base holds before the move becomes obvious. Then, July 14th US gives another lesson. The session forms at June 18th US upper memory. Price moves higher. It breaks above July 10th US upper memory. It moves toward June 22nd US midpoint. The long plan appears. Risk-reward ratio reaches 2.01. But price never touches the entry line. So there is no entry. The chart can move the right way. The plan can be correct. The account can still do nothing. That is not failure. That is discipline. Then July 14th Asia sits at the stack. July 10th US upper boundary. June 22nd US lower boundary. Weekly 0.33. They meet in the same area. The short plan appears. Risk-reward ratio reaches 2.83. But price does not touch the entry line. Even a forced entry does not reach the target. The session stays trapped. Again, no trade protects the account. Then July 15th US gives the short. The session forms compressed inside June 22nd US memory. Price cannot hold the upper side. It turns lower. Entry comes from July 15th US upper boundary. Stop sits at June 16th US lower boundary. Target sits at July 15th US lower boundary. Trail moves toward June 22nd US lower boundary. Risk-reward ratio reaches 3.13. That trade works because the upper boundary fails. It does not need prediction. It needs the line. Then July 15th Asia breaks from weekly 0.33. The session forms at June 22nd US lower memory. That same line is July 10th US upper memory. That same line is weekly 0.33. Price cannot stay above it. It breaks July 10th US lower boundary. It moves toward July 14th US midpoint. Entry comes from July 15th Asia lower boundary. Stop sits at July 15th US lower boundary. Target sits at July 14th Asia lower boundary. Trail moves toward July 10th US midpoint. Risk-reward ratio reaches 2.17. The short works because the stacked line fails. Then July 16th US retests the same stack. Price bounces into July 10th US upper boundary. That line still carries June 22nd lower memory. It still carries weekly 0.33. Price cannot stay there. The short opens. Entry comes from the July 10th US upper boundary. Stop sits at July 15th US lower boundary. Target sits at July 16th US midpoint. Risk-reward ratio reaches 1.89. That trade is smaller. It targets the midpoint. It does not ask for a full breakdown. It takes the retest failure. Then July 16th, Asia compresses again. The session forms between July 16th U.S. midpoint and lower boundary. Price cannot hold the lower side. It breaks July 9th U.S. upper memory. It moves toward July 13th U.S. upper memory. Entry comes from July 16th Asia lower boundary. Stop sits at July 16th Asia upper boundary. Target sits at July 9th U.S. upper boundary. Trail moves toward July 13th U.S. upper boundary. Risk-reward ratio reaches 3.69. That is the best short for the end of the week. Clean compression. Clean lower break. Clean target distance. Then, July 17th U.S. gives the final trap. The session forms inside July 9th U.S. memory. Price bounces. It breaks above July 16th U.S. lower boundary. It tests July 16th U.S. midpoint. The long plan appears. Risk-reward ratio reaches 1.56. But it is the final U.S. session of the week. The target is close. Distance is short. Reaction can come fast. The better trade is skip. That is the weekly rhythm. A strong short. A small profit. A massive long. A missed long. A missed short. A clean short. Another short from weekly 0.33. A retest short. A compressed short. A final session skip. The market gives many signals, but the method accepts only the ones that pay. Price reaches. It reacts. It holds or fails. Then the trade begins. Or the account waits. Price drops from compressed memory, but it cannot move free at first. The session forms inside the old US box. Before any 1-hour trade, the higher time frame comes first. Do not enter the chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading around major pressure. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines are the field. They decide where 1-hour movement can survive. A session can look quiet, but compression can hold pressure. A box can look small, but the reaction can come fast. A move can start slowly, then distance can open sharply. Now look at July 12th Asia session. July 12th Asia session forms inside the June 18th US session box. It compresses by about 50%. It overlaps there. The session forms inside old US memory. That matters. Price is not starting in empty space. It is forming inside a prior US box. The old box already carried memory. The new Asia box becomes smaller inside it. Distance becomes tighter. Reaction can come sooner. Continuation can fail earlier. When a session forms compressed inside old memory, we do not guess direction. We wait for the boundary. If the upper side fails, the short can open. If the lower side holds, the short can fail. If price stays in the middle, the account waits. After July 12th Asia session forms, price moves lower. It breaks below July 9th US session lower boundary. Then it pushes again into that lower memory area. It tests the lower side. Sellers gain control. Buyers cannot hold the old line. The move begins to open distance downward. Now read the sequence. Location: July 12th Asia forms inside June 18th US memory. Reach: price moves around the compressed Asia box. Reaction: buyers cannot defend the upper side. Failure: price breaks below July 9th US lower memory. Return: price moves toward the lower test again. Now the trade must be built in the correct order. Stop line first. Entry line second. Target line third. Most traders see the red movement. They sell late. That is not the method. The trade does not begin from the candle. The trade begins from the failed line. If the stop line is not clear, no entry. If the target does not pay, no trade. If the entry comes after the distance is gone, the trade becomes chase. For July 12th Asia session, the short setup appears. Short entry line. July 12th Asia session upper boundary. Stop loss line. June 18th US session upper boundary. First take profit line. July 9th US session upper boundary. First trailing take profit line. July 9th US session lower boundary. Risk-reward ratio: 4.28. The entry sits at July 12th Asia session upper boundary. Why there? Because the Asia session forms compressed inside June 18th US memory. The upper boundary becomes the pressure line. If price reaches the Asia upper boundary and holds above it, sellers do not control the session. If price reaches it and cannot stay, buyers fail at the compressed edge. That failure gives the short. The entry is not random. The entry is the failed hold at the upper boundary. Price reaches the upper area. It reacts. It cannot keep distance above it. Reaction comes back faster. Then, the short becomes active. The stop sits at June 18th US session upper boundary. Why there? Because the short depends on price staying under the larger US memory. The Asia box is smaller. The June 18th US box is the parent structure. If price moves above the Asia box and reaches the June 18th US upper boundary, the compression no longer controls price. The short loses its reason. So the stop belongs at the June 18th US upper boundary, not inside the compressed noise, not too tight, not placed under fear, at the line where the short idea breaks. If price reaches it, leave. No hope, no argument, no waiting for one more candle. The first target sits at July 9th US session upper boundary. Why there? After July 12th Asia upper boundary fails, price moves toward the next old US memory below. July 9th US upper boundary becomes the first working destination. It can react. It can slow the drop. It can make shorts protect profit. So the first target belongs there. Then the trade can trail toward July 9th US session lower boundary. That lower boundary is deeper. It must be earned. Price must first reach July 9th US upper boundary. It must fail to reclaim upward. Pullbacks must stay weak. Continuation must not fail early. Only then does the lower boundary become valid. Risk-reward ratio reaches 4.28. That is strong. But the number only works with clean execution. If entry comes late after price already drops below July 9th upper memory, the ratio weakens. If the stop is widened above June 18th US upper boundary, the ratio weakens. If the trader aims for the trail before the first target is earned, the trade becomes hope. The short must begin at the failed compressed upper boundary, not after the easy distance disappears. Now watch the behavior. Price breaks below July 9th US lower memory. It cannot reclaim cleanly. Pullbacks stay heavy. Reaction from buyers comes too late. Continuation keeps pressing lower. The short gains pressure. But targets still matter. If price reaches July 9th U.S. upper boundary and stalls, protect. If price breaks it and stays lower, trail. If price reaches July 9th U.S. lower boundary and reacts, protect again. Old memory can stop the move at any time. Do not freeze at the target. A target that moves without a stop is only hope. When the target moves, the stop must move too. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that becomes noise. If the stop trails too tight, normal reaction can touch it. The position disappears before the move finishes. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear. Not greed. Not the last red candle. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never returns high enough to touch it. The short pays fast. But compressed boxes can whip. A candle can retest the upper boundary. A tight stop can get touched. Then price can still fall. The idea was right. The position is gone. A conservative trader respects the June 18th U.S. upper boundary. Position size becomes smaller. The trade survives more noise. But if the stop becomes wider, the target must still pay. A wide stop with the same target damages the ratio. So every line must be checked again. Stop, entry, target, risk-reward, partial profit can help. A conservative trader can take 60% at the first target and leave 40% for the trail. An aggressive trader can take 40% first and leave 60% for continuation. For multiple stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create the edge. The edge comes from compressed upper memory failing. The edge comes from the stop protecting the parent box. The edge comes from July 9th U.S. memory giving target distance. July 12th Asia gives the first message. The session forms inside June 18th U.S. memory. The box compresses by about 50%. Price cannot stay at the upper side. It breaks toward July 9th U.S. memory. Entry. July 12th Asia upper boundary. Stop. June 18th U.S. upper boundary. Target. July 9th U.S. upper boundary. Trail. July 9th U.S. lower boundary. Risk-reward ratio. 4.28. Price reaches. It reacts. It fails. Then the short earns execution. Price keeps pressing lower, but the target does not finish cleanly. The session forms expanded inside old U.S. memory. Before reading July 13th U.S. session, keep the higher time frame visible. The weekly chart is still active. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines still shape the 1-hour chart. The previous Asia short already pushed price down. But the next trade still needs its own structure. A winning short does not give permission for another short. A red chart does not give permission. The next session must pass the same filter. Stop line first. Entry line second. Target line third. Now look at July 13th U.S. session. July 13th U.S. session forms inside July 3rd U.S. session box. It expands there. It overlaps there. The session forms inside old U.S. memory. That matters. The box is not tiny. It has more width. A wider session box gives weaker and wider support and resistance. The move can travel, but the stop can become larger. The target must still pay. If the ratio does not hold, no trade. After July 13th U.S. session forms, price moves lower. It tests July 8th U.S. session midpoint. The short pressure continues. But the movement is not smooth. Price presses lower. Reaction appears. Continuation slows. Distance becomes shorter. That behavior changes management. The setup can be valid, but the target can still fail. Now build the short. Short entry line. July 13th U.S. session upper boundary. Stop loss line. July 9th U.S. session upper boundary. Take profit line. July 8th U.S. session lower boundary. Risk-reward ratio 1.99. The entry sits at July 13th U.S. session upper boundary. Why there? Because the July 13th U.S. session forms expanded inside July 3rd U.S. memory. The upper boundary becomes the pressure line. If price reaches that upper boundary and holds above it, sellers do not control the session. If price reaches it and cannot stay, buyers fail at the top of the active U.S. box. That failure gives the short. The entry is not the first red candle. The entry is the failed upper hold. Price reaches the upper boundary. It reacts. It cannot keep distance above it. Reaction comes back lower. Then the short becomes possible. The stop sits at July 9th U.S. session upper boundary. Why there? Because the short depends on price staying below the older upper memory. July 9th U.S. upper boundary is above the active failure zone. If price reclaims that line, the short pressure breaks. The market is no longer accepting lower. The short loses its reason. So the stop belongs there. Not inside the middle of the box. Not under the last candle. Not where fear feels comfortable. At the line where the trade idea fails. If price reaches it, leave. No hope. No argument. No waiting for another candle. The target sits at July 8th U.S. session lower boundary. Why there? After July 13th U.S. upper boundary fails, price has a path toward older July 8th memory below. July 8th U.S. lower boundary is the structural destination. It can react. It can slow the drop. It can become the place where shorts protect profit. So the target is not random. It is the next old boundary. Risk-reward ratio reaches 1.99. That passes the filter. But it is not a wide edge. That matters. A 1.99 trade needs clean execution. A late entry can destroy it. A wider stop can destroy it. A slow session can leave the target unfinished. And that is what happens. Price moves lower. It tests toward July 8th U.S. midpoint, but it does not reach July 8th U.S. lower boundary inside July 13th U.S. session. The target fails to arrive. The trade does not fully pay. The move stalls. Reaction returns. Continuation loses speed. Then the position must be managed. This is where many traders freeze. They entered short. The plan looked clean. The chart moved in the right direction. So they keep waiting for the full target. But the market already changed behavior. Distance stopped expanding. Reaction started coming faster. The target stayed unreached. The trade no longer has the same quality. When target distance stops opening, protect. When continuation fails earlier, protect. When price cannot reach the next boundary, reduce. That is why this trade ends with small profit. Not because the setup was wrong, because the move did not complete. A valid trade can pay only partly. A clean ratio can shrink during execution. A target can stay untouched. Then the trader must adapt. No revenge. No hope. No forced hold. Just line by line. If price cannot continue toward July 8th U.S. lower boundary, profit must be protected. If price returns toward the entry area, reduce. If price reclaims the failed upper zone, exit. If price reaches the stop, the answer is already given. Now compare the two structures. July 12th Asia gave a strong short. Entry. July 12th Asia upper boundary. Stop. June 18th U.S. upper boundary. Target. July 9th U.S. upper boundary. Trail. July 9th U.S. lower boundary. Risk-reward ratio. 4.28. The compression failed. Distance opened. The short paid. July 13th U.S. gives another short. Entry. July 13th U.S. upper boundary. Stop. July 9th U.S. upper boundary. Target. July 8th U.S. lower boundary. Risk-reward ratio. 1.99. The structure was valid, but the move did not finish. The difference is important. The first trade gives distance. The second trade gives friction. The first trade reaches targets. The second trade stalls before target. Same method. Different result. That is live trading. You cannot demand the market to finish every plan. You execute the plan. Then you read the behavior. If price keeps moving, you hold. If price stalls, you protect. If price reverses, you leave. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price drops fast. The trade pays quickly. But an expanded box can pull back deeper. A tight stop can get touched. Then, price can still move lower later. The idea was right. The position is gone. A conservative trader respects July 9th U.S. upper boundary. Position size becomes smaller. The trade survives more noise. But if the stop becomes wider, the target must still pay. A wide stop with a 1.99 setup can become weak fast. So the conservative trader must not widen the stop blindly. The stop must still protect the idea. The target must still justify the risk. The trade must still pass the 1.5 filter. No trailing target is used here. That matters. Without trailing, the management becomes simpler. Target. Stop. Behavior. If the target does not arrive and the move stalls, take what the market gives. Do not turn small profit into loss. Do not force a structural target after the structure weakens. The market already warned. Pullbacks deepen. Reaction speeds up. Continuation fails earlier. Distance becomes shorter. That is the exit pressure. July 13th U.S. gives the second message. The session forms expanded inside July 3rd U.S. memory. Price rejects the upper boundary. The short opens. It moves lower. It cannot reach July 8th U.S. lower boundary. The move stalls. The trade ends with small profit. Entry. July 13th U.S. upper boundary. Stop. July 9th U.S. upper boundary. Target. July 8th U.S. lower boundary. Risk-reward ratio. 1.99. Price reaches. It reacts. It fails to finish. Then the account protects. Price launches upward, but it starts from compression. The session forms inside July 8th U.S. memory. Before any 1-hour trade, the higher time frame comes first. Do not enter the chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading around major pressure. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines are the field. They decide where 1-hour movement can survive. A candle can rise fast, but it still needs a base. A bounce can look strong, but if the lower boundary fails, the long dies. A breakout can look obvious, but if entry comes late, the trade becomes chase. Now look at July 13th Asia session. July 13th Asia session forms inside July 8th US session box. It compresses there. It overlaps there. The session forms inside old US memory. That matters. Price is not starting in clean space. It is building pressure inside a prior US box. The new Asia box is smaller. The old US memory holds the outside range. The lower side becomes the base. The upper side becomes the first release point. When a session forms compressed inside old memory, we do not guess. We wait. If price loses the lower boundary, the long is not ready. If price holds the lower boundary, the long can start. If price breaks the upper line and holds, distance can open fast. After July 13th Asia session forms, price moves higher. It breaks above July 13th US session upper boundary. Then it breaks above July 9th US session upper boundary. Then it reaches into June 18th US session memory. It tests June 18th US session midpoint. The move does not crawl. It expands. Reaction comes. But buyers keep control. Pullbacks stay shallow. Continuation keeps opening. Now read the sequence. Location. July 13th Asia forms inside July 8th US memory. Reach. Price tests the compressed Asia range. Reaction. Sellers cannot push price through the lower side. Failure. Downside continuation fails. Return. Price moves upward through July 13th US memory and July 9th US memory. Now the trade must be built in the correct order. Stop line first. Entry line second. Target line third. Most traders see the green candle. They buy late. That is not the method. The long does not begin because price is green. The long begins because the lower boundary holds. If the stop line is not clear, no entry. If the target does not pay, no trade. If the entry comes after the distance is already open, the risk-reward dies. For July 13th Asia session, the long setup appears. Long entry line. July 13th Asia session, lower boundary. Stop loss line. July 8th US session, lower boundary. First take profit line. June 19th US session, upper boundary. First trailing take profit line. July 13th Asia session, upper boundary. Second trailing take profit line. July 13th US session, upper boundary. Third trailing take profit line. July 9th US session, upper boundary. Fourth trailing take profit line. June 18th US session, upper boundary. Risk-reward ratio 9.25. The entry sits at July 13th Asia session, lower boundary. Why there? Because the Asia session forms compressed inside July 8th US memory. The lower boundary becomes the defended base. If price reaches that lower boundary and breaks below it, the long has no control. If price reaches it and cannot stay below, sellers fail. That hold gives the long. The entry is not the breakout candle. The entry is the defended lower side of the compressed box. Price reaches the lower area. It reacts. It cannot continue lower. Distance begins to open upward. Then the long becomes active. The stop sits at July 8th U.S. session lower boundary. Why there? Because the long depends on July 8th U.S. memory holding underneath the Asia box. The Asia box is compressed. The July 8th U.S. box is the parent memory. If price loses July 8th U.S. lower boundary, the base is gone. The recovery loses control. The long loses its reason. So the stop belongs at July 8th U.S. lower boundary, not inside random noise, not under the last small candle, not where fear feels comfortable, at the line where the idea breaks. If price reaches it, leave. No hope, no argument, no waiting for another candle. The first target sits at June 19th U.S. session upper boundary. Why there? After July 13th Asia lower boundary holds, price moves into old U.S. memory above. June 19th U.S. upper boundary becomes the first working destination. It can react. It can slow the move. It can make buyers protect profit. So the first target belongs there. Then the trail begins. The first trail moves toward July 13th Asia session upper boundary. Why? Because once price leaves the lower side, the opposite side of the same compressed box becomes the next active release line. If price reaches it and cannot pass, protect. If price breaks it and holds, continuation can open. The second trail moves toward July 13th U.S. session upper boundary. Why? Because the next session memory above becomes the next reaction zone. It can reject. It can stall. It can pull price back, so profit must follow structure. The third trail moves toward July 9th U.S. session upper boundary. Why? Because price has to reclaim old upper memory. If it reaches that line and cannot stay, the long can lose speed. If it breaks and holds, the final trail can open. The fourth trail moves toward June 18th U.S. session upper boundary. Why? Because that line is higher old U.S. memory. It is a major upper target in this route. It can stop the move. It can trigger a hard reaction. So the trail does not ignore it. Risk-reward ratio reaches 9.25. That is huge. But it only exists because the entry is near the lower boundary. Late entry destroys it. If the trader buys after July 13th U.S. upper boundary breaks, the distance is already gone. If the stop is widened below July 8th U.S. lower boundary, the math changes. If the trader waits for proof too late, the trade becomes chase. The long must start from the base, not from excitement. Now watch the behavior. Price holds the compressed lower side. It pushes upward. It breaks July 13th U.S. upper memory. It breaks July 9th U.S. upper memory. It reaches toward June 18th memory. Pullback stays shallow. Reaction fails earlier. Distance opens higher. The long gains pressure. But targets still matter. A massive risk-reward trade still needs protection. If price reaches June 19th U.S. upper boundary and stalls, protect. If price reaches July 13th Asia upper boundary and reacts, protect. If price reaches July 13th U.S. upper boundary and slows, protect again. If price reaches July 9th U.S. upper boundary and cannot stay above it, protect. If price reaches June 18th U.S. upper boundary, do not freeze. That line can hit back. A target that moves without a stop is only hope. When the target moves, the stop must move too. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that becomes noise. If the stop trails too tight, normal reaction can touch it. The position disappears before the real expansion. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear. Not greed. Not the last green candle. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never returns deep enough to touch it. The long runs. But compressed boxes can retest. A candle can come back into the base. A tight stop can get touched. Then price can still launch. The idea was right. The position is gone. A conservative trader respects July 8th U.S. lower boundary. Position size becomes smaller. The trade survives deeper noise, but the target must still pay. Here, the distance is wide. The route gives room. That is why the conservative stop can still work. Partial profit can help. For one trail, a conservative trader can take 60% first and leave 40%. An aggressive trader can take 40% first and leave 60%. For multiple trails, the split must fit the trader. A conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. With 4 trailing zones, the principle remains. Take enough to protect. Leave enough to let distance work. But the split does not create the edge. The edge comes from the compressed base holding. The edge comes from the stop protecting the parent US box. The edge comes from old US memory giving huge target distance. July 13th, Asia gives the first message. The session forms inside July 8th US memory. Price holds the lower side. It breaks July 13th US upper memory. It breaks July 9th US upper memory. It reaches toward June 18th US memory. Entry: July 13th Asia lower boundary. Stop: July 8th US lower boundary. Target: June 19th US upper boundary. Trail: July 13th Asia upper boundary. Second trail: July 13th US upper boundary. Third trail: July 9th US upper boundary. Fourth trail: June 18th US upper boundary. Risk-reward ratio: 9.25. Price reaches. It reacts. It holds. Then the long earns expansion. Price keeps pushing higher, but the entry never comes back. The session forms at June 18th US upper memory. Before reading July 14th US session, keep the higher time frame visible. The weekly chart is still active. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines still shape the 1-hour chart. The previous Asia long already expanded hard. But a strong move does not allow careless entry. A big win does not give permission for the next trade. The next session must still pass the same filter. Stop line first. Entry line second. Target line third. Now look at July 14th US session. July 14th US session forms at June 18th US session upper boundary. It compresses there. It overlaps there. This session forms at the boundary of old US memory. That matters. Price has already pushed upward from the July 13th Asia base. Now it reaches a higher old line. The chart looks strong, but upper memory can still react. A compressed box near old upper memory can release higher. It can also trap late buyers, so the entry must be exact. After July 14th U.S. session forms, price moves higher. It breaks above July 10th U.S. session upper boundary. Then it pushes toward June 22nd U.S. session midpoint. It tries to test that higher old memory. The long idea appears. But the entry line is not touched. The plan exists. The trade does not. That is the most important part. A setup can form. A target can be clear. A risk-reward ratio can pass the filter. But if price does not touch the entry line, there is no entry, no chase, no late buy, no emotional fill, no trade. Now read the sequence. Location. July 14th U.S. forms at June 18th U.S. upper memory. Reach. Price pushes toward July 10th U.S. upper memory. Reaction. Sellers try to slow the move. Failure. Price continues toward June 22nd midpoint. Return. Price never gives the planned entry. Now build the long plan. Long entry line. July 14th U.S. session upper boundary. Stop loss line. July 14th U.S. session lower boundary. Take profit line. June 22nd U.S. session midpoint. Risk-reward ratio. 2.01. The entry sits at July 14th U.S. session upper boundary. Why there? Because the U.S. session forms compressed at June 18th U.S. upper memory. The upper boundary becomes the confirmation line. If price breaks above it and then returns to test it, the line can become support. That gives a clean long. If price never returns to it, the trade has no fill. The entry is not any green candle above the box. The entry is the touch and hold of the planned line. Price moves higher. It does not come back. So the account waits. The stop sits at July 14th U.S. session lower boundary. Why there? Because the long depends on the July 14th U.S. box, holding after the upper break. If price returns through the whole box and reaches the lower boundary, the breakout has failed. The market is not accepting higher. The long loses control, so the stop belongs at the lower boundary, not under a random wick, not inside the middle, at the line where the idea breaks. But the position never opens, so the stop remains a plan, not a trade. The target sits at June 22nd U.S. session midpoint. Why there? After July 14th U.S. upper boundary holds, price has a route toward June 22nd U.S. memory. The midpoint is the next working destination. It can react, it can reject, it can stop continuation. So the target is structural. Risk-reward ratio reaches 2.01. It passes the filter. But the entry still matters more. A 2.01 plan becomes bad if the trader chases above the entry. If price runs without touching the line, the ratio changes. If the trader buys late near the target, the stop stays far. The target stays close. The math breaks. That is why the entry miss matters. The market can move exactly as expected, and the trader still does nothing. That is not failure. That is discipline. The plan was good. The line was clear. The target was clear. But price did not touch the entry, so the trade does not open. Many traders cannot accept that. They see the move. They see the target. They feel left behind. Then they enter late. The move stalls. Reaction comes back. The late entry gets trapped. That is how a good plan becomes a bad trade. We do not do that. If price does not reach the entry line, we wait. If price runs without us, we wait. If price reaches the target without us, we wait. The account does not need every move. The account needs good fills. Now watch the behavior. Price moves above July 10th U.S. upper boundary. It keeps pushing upward. It aims toward June 22nd U.S. midpoint. The move confirms strength. but it does not confirm our entry. There is a difference. Strength can be real, but without entry, there is no trade. The chart can be right. The plan can be right. The account still waits. That is part of execution. Now compare the two structures. July 13th, Asia gives a huge long. Entry. July 13th, Asia lower boundary. Stop. July 8th, US lower boundary. Target. June 19th, US upper boundary. Trail. July 13th, Asia upper boundary. Second trail. July 13th, US upper boundary. Third trail. July 9th, US upper boundary. Fourth trail. June 18th, US upper boundary. Risk-reward ratio, 9.25. The entry appears. The base holds. Distance opens. The trade runs. July 14th, US gives another long plan. Entry. July 14th, US upper boundary. Stop. July 14th, US lower boundary. Target. June 22nd, US midpoint. Risk-reward ratio, 2.01. But price does not touch the entry line. The trade does not open. Same method. Different action. One trade runs. One trade waits. That is how the strategy survives. It does not force every good idea into a position. It only enters when price gives the line. Now trader type matters. An aggressive trader may chase the breakout. That can work sometimes. Price may continue without retest. The trader may catch the move. But the stop becomes unclear. The ratio becomes worse. The pressure becomes emotional. If reaction comes back, the late long suffers. A conservative trader waits for the planned entry. If the line is missed, there is no trade. The move can still reach target. The trader misses it. But the account is protected. That missed trade is not a loss. It is saved risk. A clean trading method must allow missed moves. Without that, every chart becomes pressure. Every green candle becomes regret. Every missed candle becomes revenge. Then the next trade gets damaged. No entry protects the next decision. No entry keeps the mind clean. No entry keeps risk intact. There is no trailing explanation here. No position opened. No trailing target was used. The only job is to respect the missed entry. If price later returns to the line, check again. Did the session still hold? Did the target still pay? Did risk-reward remain above 1.5? If yes, the setup can be rebuilt. If no, the account waits. Do not use an old plan after the market has changed. Plans expire when distance changes. Plans expire when target space shrinks. Plans expire when reaction speed changes. Now final read. July 14th US session forms at June 18th US upper memory. Price breaks above July 10th US upper memory. It moves toward June 22nd US midpoint. The long plan is clear. Entry. July 14th US upper boundary. Stop. July 14th US lower boundary. Target. June 22nd US midpoint. Risk-reward ratio, 2.01. But price does not touch the entry line. No entry. No chase. No trade. Price reaches. It reacts. It runs without us. Then the account waits. Price sits at weekly 0.33, but it cannot leave the Asia box. The session forms at the boundary of old US memory. Before any 1-hour trade, the higher time frame comes first. Do not enter the chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading around major pressure. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines are the field. They decide where 1 hour movement can survive. A session can reach weekly 0.33. But it still has to move away. A box can form on the line. But if price stays inside, the trade stays trapped. A plan can have clean risk-reward. But if entry never comes, the account waits. Now look at July 14th Asia session. July 14th Asia session forms at July 10th U.S. session upper boundary. That same line also sits at June 22nd U.S. session lower boundary. It also sits near weekly 0.33. So the session forms at the boundary of stacked memory. July 10th U.S. upper boundary. June 22nd U.S. lower boundary. Weekly 0.33. Those lines overlap. Price is standing on a crowded line. That matters. The market is not moving through clean space. It is sitting where many traders react. When several memories overlap, distance can shrink. Reaction can come faster. Continuation can fail earlier. The session forms at the boundary of old U.S. memory. But price does not break away. After July 14th Asia session forms, price stays inside the Asia box. It does not give clean downside expansion. It does not give clean upside release. It moves inside the range. The chart looks ready, but readiness is not execution. The line must be touched. The line must fail. The distance must open. Without that, no trade. Now read the sequence. Location. July 14th Asia forms at July 10th U.S. upper memory. It also forms at June 22nd U.S. lower memory. It also sits at weekly 0.33. Reach. Price moves inside the Asia box. Reaction. Both sides respond near the same range. Failure. Continuation cannot leave the box cleanly. Return. Price keeps moving inside the session boundary. Now the trade plan must be built in the correct order. Stop line first. Entry line second. Target line third. Most traders see the crowded line. They want to trade immediately. That is not the method. The trade does not start because weekly 0.33 is nearby. The trade does not start because the box is visible. The trade does not start because the target looks clean. The trade starts only when price gives the entry line. If the stop line is not clear, no entry. If the target does not pay, no trade. If price never touches entry, no trade. For July 14th Asia session, the short plan appears. Short entry line. July 14th Asia session upper boundary. Stop loss line. June 22nd U.S. session upper boundary. Take profit line. July 10th U.S. session lower boundary. Risk-reward ratio. 2.83. The entry sits at July 14th Asia session upper boundary. Why there? Because the session forms at stacked resistance memory. July 10th U.S. upper boundary. June 22nd U.S. lower boundary. Weekly 0.33. If price reaches the Asia upper boundary and cannot stay above it, the short can start. The upper boundary becomes the failed hold line. The trade needs that failure. Without that touch, there is no entry. Price must reach the upper boundary. It must react. It must fail to hold. Then distance can open lower. But price does not touch the entry line. So the short does not open. The stop sits at June 22nd U.S. session upper boundary. Why there? Because the short depends on price failing under the stacked memory area. If price moves above the Asia upper boundary and reaches June 22nd U.S. upper boundary, the rejection has failed. The market is not accepting lower. The short loses control. So the stop belongs at June 22nd U.S. upper boundary, not inside the box, not under a random candle, at the line where the idea breaks. But the position never opens. So the stop remains only a plan, not a real risk. The target sits at July 10th U.S. session lower boundary. Why there? If July 14th Asia upper boundary fails, price can return toward the lower side of July 10th U.S. memory. That line can react. That line can slow the drop. That line can become the place where shorts protect profit. So the target is structural. Risk-reward ratio reaches 2.83. That is clean. But the market does not give the entry. That is the pain. The setup is visible. The ratio is good. The level is important. The trade still does not open. This is where many traders break discipline. They see weekly 0.33. They see the short plan. They see price staying inside the box. Then they enter early. But early entry is not the method. If price never touches the upper boundary, the stop distance changes. If price stays in the middle, the target distance changes. If price keeps rotating inside the box, reaction becomes noise. Then a clean plan becomes a weak trade. So the account waits. And even if a trader forced the entry, the move still does not reach the target. Price stays inside the July 14th Asia session box. It does not move down to July 10th U.S. lower boundary. The short does not get paid. That matters. The chart did not only miss entry, it also failed the target path. The session showed friction. Distance stayed short. Reaction came back inside. Continuation failed inside the same box. The move did not leave the range. So the correct action is simple. No entry. No chase. No forced short. No regret. Now compare this with the prior day. July 13th Asia gave a huge long. The session formed inside July 8th U.S. memory. Price held the lower side. It broke old upper memories. The long reached multiple targets. Risk-reward ratio reached 9.25. That was expansion. July 14th Asia is different. The session forms at weekly 0.33. It overlaps stacked memory. It stays inside the box. The short plan has 2.83 risk-reward. But the entry does not come. The target path does not complete. That is compression. A trader must know the difference. Expansion allows holding. Compression demands patience. If the box does not break, the account waits. If entry is not touched, the account waits. If target distance does not open, the account waits. Now trader type matters. An aggressive trader may short early inside the box. The stop can feel smaller. The position can feel better. But inside box movement can cut both sides. Price can rotate upward. It can retest the upper line. It can stop the trade before direction appears. Then price can still drift lower later. The idea was not terrible. The execution was early. A conservative trader waits for the exact entry. If price does not touch the July 14th Asia upper boundary, there is no position. The move can still look tradable. But the account stays clean. No position is not weakness. No position is discipline. No position protects the next trade. There is no trailing here. No entry. No first target. No trail. Do not explain trailing when the market did not give the trade. The only lesson is execution. A plan is not a trade. A line is not an entry until price reaches it. A target is not profit until price travels there. Now final read. July 14th Asia session forms at July 10th U.S. upper boundary. That same area overlaps June 22nd U.S. lower boundary. It also sits near weekly 0.33. Price stays inside the Asia box. The short plan appears. Entry. July 14th, Asia upper boundary. Stop. June 22nd, U.S. upper boundary. Target. July 10th, U.S. lower boundary. Risk-reward ratio. 2.83. But price does not touch the entry. Even a forced entry does not reach the target. Price reaches. It reacts. It stays trapped. Then the account waits. Price turns down from compressed memory. But the short still needs the lower break. The session forms inside the June 22nd U.S. box. Before reading July 15th U.S. session, keep the higher time frame visible. The weekly chart is still active. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines still shape the 1-hour chart. The previous Asia plan did not open. Price stayed trapped inside the box. But the next U.S. session gives a new structure. A missed trade does not carry into the next setup. A no-entry session does not damage the next read. We start again. Stop line first. Entry line second. Target line third. Now look at July 15th U.S. session. July 15th U.S. session forms inside June 22nd U.S. session box. It compresses there. It overlaps there. The session forms inside old U.S. memory. That matters. June 22nd U.S. memory is above the recent lower rotation. It is also near the area where the prior Asia session could not break cleanly. Now the new U.S. box compresses inside it. Compression returns. The market gives a tighter decision area. If price holds the upper side, the short is not ready. If price fails the upper side and breaks lower, the short can open. If price stays in the middle, no trade. After July 15th U.S. session forms, price moves lower. It tests June 22nd U.S. session lower boundary. The short pressure becomes visible. Buyers fail to keep price inside the upper part of the box. The lower boundary gets attacked. Reaction tries to slow the move. But the lower path opens. Now read the sequence. Location. July 15th U.S. forms inside June 22nd U.S. memory. Reach. Price tests the upper area first. Reaction. Buyers cannot create continuation above the box. Failure. The session turns lower. Return. Price moves toward the July 15th U.S. lower boundary and June 22nd U.S. lower memory. Now build the short. Short entry line. July 15th U.S. session upper boundary. Stop loss line. June 16th U.S. session lower boundary. First take profit line. July 15th U.S. session lower boundary. First trailing take profit line. June 22nd U.S. session lower boundary. Risk-reward ratio. 3.13. The entry sits at July 15th U.S. session upper boundary. Why there? Because the session forms compressed inside June 22nd U.S. memory. The upper boundary becomes the pressure line. If price reaches that upper boundary and holds above it, sellers do not control the session. If price reaches it and cannot stay, buyers fail at the top of the compressed box. That failure gives the short. The entry is not the first red candle. The entry is the failed upper hold. Price reaches the upper area. It reacts. It cannot keep distance above it. Reaction returns lower. Then, the short becomes active. The stop sits at June 16th U.S. session lower boundary. Why there? Because the short depends on price staying under higher old memory. June 16th U.S. lower boundary sits above the active compression. If price reaches that line, the market has reclaimed too much. The short pressure is no longer clean. The rejection has failed. The short loses its reason. So the stop belongs at June 16th U.S. lower boundary, not inside random noise, not just above the entry, not where fear feels comfortable, at the line where the idea breaks. If price reaches it, leave. No hope. No argument. No waiting for another candle. The first target sits at July 15th U.S. session lower boundary. Why there? After the upper boundary fails, the lower side of the same U.S. box becomes the first working destination. It can react. It can slow the drop. It can make shorts protect profit. So the first target belongs there. Then the trade can trail toward June 22nd U.S. session lower boundary. Why there? Because the July 15th box forms inside June 22nd memory. Once price breaks through the active U.S. lower side, the parent June 22nd lower boundary becomes the next target. That line can react hard. It can stop continuation. It can trigger a pullback. So the trail must respect it. Risk-reward ratio reaches 3.13. That is clean. But the trade still needs precise execution. If entry comes late after price already drops toward the lower boundary, the ratio weakens. If the stop is widened above June 16th U.S. lower boundary, the ratio weakens. If the trader aims for June 22nd lower boundary before the first target is earned, the trade becomes hope. The short must begin at the failed upper boundary, not after the distance is gone. Now watch the behavior. Price fails the upper side. It moves lower. The lower side of July 15th U.S. box gets tested. Reaction appears. But buyers cannot recover cleanly. Continuation pushes toward June 22nd lower memory. Distance opens downward. The short gains pressure. This is different from July 14th Asia. July 14th Asia stayed inside the box. July 15th U.S. presses through the box. July 14th Asia did not touch entry. July 15th U.S. gives execution. July 14th Asia did not reach target. July 15th U.S. gives first target and trail pressure. The method did not change. The market behavior changed. That is why we do not force the first plan. We wait for the next real line. Now target management matters. If price reaches July 15th U.S. lower boundary and stalls, protect. If price breaks it and stays lower, trail. If price reaches June 22nd U.S. lower boundary and reacts, protect again. A target that moves without a stop is only hope. When the target moves, the stop must move too. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that becomes noise. If the stop trails too tight, normal reaction can touch it. The position disappears before the move finishes. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear. Not greed. Not the last red candle. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never returns high enough to touch it. The short pays fast. But compressed U.S. boxes can retest. A wick can move back toward the upper boundary. A tight stop can get touched. Then price can still fall. The idea was right. The position is gone. A conservative trader respects June 16th U.S. lower boundary. Position size becomes smaller. The trade survives more noise. But if the stop becomes too wide, the target must still pay. A wide stop with the same target can destroy the setup. So every line must work together. Stop, entry, target, risk-reward. Partial profit can help. A conservative trader can take 60% at the first target and leave 40% for the trail. An aggressive trader can take 40% first and leave 60% for continuation. For multiple stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create the edge. The edge comes from the failed upper boundary. The edge comes from the stop protecting the higher memory. The edge comes from the parent June 22nd lower boundary giving distance. July 15th U.S. gives the second message. The session forms inside June 22nd U.S. memory. Price cannot hold the upper side. It turns lower. It tests June 22nd lower memory. Entry, July 15th U.S. upper boundary. Stop, June 16th U.S. lower boundary. Target, July 15th U.S. lower boundary. Trail, June 22nd U.S. lower boundary. Risk-reward ratio, 3.13. Price reaches. It reacts. It fails higher. Then the short earns execution. Price falls from stacked memory. But it still has to break the lower box. The session forms at weekly 0.33. Before any 1-hour trade, the higher time frame comes first. Do not enter the chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading around major pressure. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines are the field. They decide where 1-hour movement can survive. A session can form near weekly 0.33, but it still has to hold. A box can compress on a major line, but compression can break both ways. A trader can see pressure, but the trade still needs the boundary. Now look at July 15th Asia session. July 15th Asia session forms at June 22nd U.S. session lower boundary. It compresses there. It overlaps there. The session forms at the boundary of stacked memory. That same June 22nd U.S. lower boundary is also July 10th U.S. session upper boundary. It is also weekly 0.33. So price is not sitting on one line. It is sitting on several lines at once. June 22nd U.S. lower memory. July 10th U.S. upper memory. Weekly 0.33. That creates a crowded zone. A crowded zone can look strong, but it can also trap late buyers. When price cannot move away from that zone, reaction speeds up. Distance becomes shorter. Continuation fails earlier. The first question is not direction. The first question is holding. Can price stay above weekly 0.33? Can price hold the compressed Asia box? Can price keep distance above old US memory? If not, the short can appear. After July 15th Asia session forms, price moves lower. It breaks below July 10th US session lower boundary. That is the first visible failure. Then price keeps pressing lower. It tests July 14th US session midpoint. The market returns into lower memory. Buyers fail to defend the stacked 0.33 area. Sellers push price back into the prior US range. Now read the movement. Location: July 15th Asia forms at June 22nd US lower memory. Reach: price works around the compressed Asia box. Reaction: buyers cannot expand above weekly 0.33. Failure: price breaks below July 10th US lower boundary. Return: price moves toward July 14th US midpoint. Now the trade must be built in the correct order. Stop line first. Entry line second. Target line third. Most traders see the drop. They sell late. That is not the method. The short does not begin with the red candle. The short begins when the lower boundary fails. If the stop line is not clear, no entry. If the target does not pay, no trade. If the entry comes after distance is gone, the trade becomes chase. For July 15th Asia session, the short setup appears. Short entry line. July 15th Asia session lower boundary. Stop loss line. July 15th US session lower boundary. First take profit line. July 14th Asia session lower boundary. First trailing take profit line. July 10th US session midpoint. Risk-reward ratio 2.17. The entry sits at July 15th Asia session lower boundary. Why there? Because the session forms compressed at weekly 0.33. The lower boundary becomes the first failure line. If price stays above that lower boundary, sellers do not control the session. If price breaks below it and cannot reclaim, the compressed box loses support. That gives the short. The entry is not random. The entry is the failed lower side of the Asia box. Price reaches the lower boundary. It breaks. It tries to return. It cannot stay back inside. Distance opens downward. Then the short becomes active. The stop sits at July 15th US session lower boundary. Why there? Because the short depends on the market staying under the higher active memory. If price recovers into July 15th US lower boundary, the downside failure is no longer clean. The market has reclaimed too much. The short loses control. So the stop belongs there. Not inside random noise. Not just above the entry candle. Not where fear feels comfortable. At the line where the trade idea breaks. If price reaches it, leave. No hope. No argument. No waiting for one more candle. The first target sits at July 14th Asia session lower boundary. Why there? After July 15th Asia lower boundary fails, price moves toward older Asia memory below. July 14th Asia lower boundary becomes the first working destination. It can react. It can slow the drop. It can make shorts protect profit. So the first target belongs there. Then the trade can trail toward July 10th US session midpoint. Why there? Because after price moves through the first lower memory, the next deeper old US midpoint becomes the route. But that target must be earned. Price must first reach July 14th Asia lower boundary. It must fail to reclaim upward. Pullbacks must stay weak. Continuation must not fail early. Only then does July 10th US midpoint become valid. Risk-reward ratio reaches 2.17. That passes the filter. But it still needs clean execution. If entry comes late after price already drops toward July 14th Asia lower boundary, the ratio weakens. If the stop is widened above July 15th U.S. lower boundary, the ratio weakens. If the trader aims for the trail before the first target is earned, the trade becomes hope. The short must start at the failed Asia lower boundary, not after the easy distance disappears. Now watch the behavior. Price leaves the 0.33 stack. It breaks July 10th U.S. lower boundary. It reaches toward July 14th U.S. midpoint. Reaction tries to recover. But buyers cannot reclaim the broken line cleanly. Pullbacks stay heavy. Continuation keeps moving lower. The short gains pressure. But targets still matter. If price reaches July 14th Asia lower boundary and stalls, protect. If price breaks it and holds lower, trail. If price reaches July 10th U.S. midpoint and reacts, protect again. Old memory can hit back. Do not freeze at the target. A target that moves without a stop is only hope. When the target moves, the stop must move too. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that becomes noise. If the stop trails too tight, normal reaction can touch it. The position disappears before the move finishes. If the stop stays too far behind, the trail protects nothing. So the stop follows structure, not fear, not greed, not the last red candle. Now, trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never returns high enough to touch it. The short pays fast. But compressed boxes around weekly 0.33 can whip. A candle can retest the broken lower boundary. A tight stop can get touched. Then price can still fall. The idea was right. The position is gone. A conservative trader respects July 15th U.S. lower boundary. Position size becomes smaller. The trade survives more noise. But if the stop becomes wider, the target must still pay. A wide stop with the same target damages the ratio. So every line must be checked together. Stop. Entry. Target. Risk-reward. Partial profit can help. A conservative trader can take 60% at the first target and leave 40% for the trail. An aggressive trader can take 40% first and leave 60% for continuation. For multiple stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create the edge. The edge comes from weekly 0.33 failing. The edge comes from the stop protecting higher memory. The edge comes from old Asia and U.S. memory giving target distance. July 15th, Asia gives the first message. The session forms at June 22nd U.S. lower memory. That same line is July 10th U.S. upper memory. That same line is weekly 0.33. Price cannot stay above it. It breaks July 10th U.S. lower boundary. It moves toward July 14th U.S. midpoint. Entry. July 15th Asia lower boundary. Stop. July 15th U.S. lower boundary. Target. July 14th Asia lower boundary. Trail. July 10th U.S. midpoint. Risk-reward ratio. 2.17. Price reaches. It reacts. It fails higher. Then the short earns execution. Price bounces into 0.33. But it cannot stay there. The session forms between two old midpoints. Before reading July 16th U.S. session, keep the higher time frame visible. The weekly chart is still active. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines still shape the 1-hour chart. The prior short pushed price lower. But the next U.S. session does not need to keep falling. Price can bounce. It can reclaim part of the drop. It can return to the same old line. Then the market must prove holding again. Do not carry the last trade into the next session. Start again. Stop line first. Entry line second. Target line third. Now look at July 16th U.S. session. July 16th U.S. session forms between July 14th U.S. session midpoint and July 10th U.S. session midpoint. It overlaps there. The session forms inside old midpoint memory. That matters. It is not at the high. It is not at the low. It forms between two old control lines. Midpoint areas often create hesitation. Price moves above. It returns. Price moves below. It reacts. Distance becomes shorter. Continuation can fail earlier. After July 16th U.S. session forms, price moves higher. It tests July 10th U.S. session upper boundary. That same line is June 22nd U.S. session lower boundary. It is also weekly 0.33. So price returns to the same stacked line. The same place that failed before now gets tested again. That creates the short idea. But not immediately. The short needs failed holding at the retest. Location. July 16th U.S. forms between July 14th U.S. midpoint and July 10th U.S. midpoint. Reach. Price rises toward July 10th U.S. upper boundary. Reaction. Buyers try to reclaim weekly 0.33. Failure. Price cannot stay above the stacked line. Return. Price moves back toward July 16th U.S. midpoint. Now build the short. Short entry line. July 10th U.S. session upper boundary. Stop loss line. July 15th U.S. session lower boundary. Take profit line. July 16th U.S. session midpoint. Risk-reward ratio. 1.89. The entry sits at July 10th U.S. session upper boundary. Why there? Because that line carries stacked memory. July 10th U.S. upper boundary. June 22nd U.S. lower boundary. Weekly 0.33. If price reaches that line and holds above it, the short is not ready. If price reaches it and cannot stay, the reclaim fails. That failure gives the short. The entry is not the first red candle after the bounce. The entry is the failed hold at the stacked upper memory. Price reaches the line. It reacts. It cannot keep distance above it. Reaction comes back faster. Then the short becomes active. The stop sits at July 15th U.S. session lower boundary. Why there? Because the short depends on price staying below the prior upper pressure zone. If price moves through the entry area and reaches July 15th U.S. lower boundary above, the failed reclaim is gone. The market has accepted higher memory. The short loses control. So the stop belongs at July 15th U.S. lower boundary. Not random. Not emotional. Not just above a small wick. At the line where the idea breaks. If price reaches it, leave. No hope. No argument. No waiting for another candle. The target sits at July 16th U.S. session midpoint. Why there? After the 0.33 retest fails, price returns to the active U.S. control line. July 16th U.S. midpoint becomes the first destination. It can react. It can slow the drop. It can make shorts protect profit. So the target is structural. Risk-reward ratio reaches 1.89. That passes the filter. But it is not huge. That matters. A 1.89 trade needs clean entry. A late entry can kill the ratio. A wider stop can kill the ratio. A forced target below the midpoint can turn the trade into hope. The short must start near the failed retest, not after the move already returns to the middle. Now watch the behavior. Price rises toward July 10th US upper boundary. It tests the stacked line. Weekly 0.33 is there. June 22nd lower memory is there. July 10th upper memory is there. The bounce looks strong, but it cannot keep distance. Reaction comes back. Price starts returning toward the July 16th US midpoint. The move becomes a failed reclaim. That gives the short, but the target is close. Do not expect a huge breakdown from a closed target setup. This trade is about the retest, not about a full trend. The job is to enter near the failed 0.33 line. Then, take the midpoint. If price reaches the midpoint and stalls, protect. If price cannot return to the midpoint, reduce. If price reclaims the stacked line again, exit. There is no reason to turn a 1.89 setup into a long hold. The market is still inside old memory. The session formed between midpoints. Distance is not wide. The target must be respected. Now compare the two structures. July 15th Asia gives a short from the lower break. Entry. July 15th Asia lower boundary. Stop. July 15th US lower boundary. Target. July 14th Asia lower boundary. Trail. July 10th US midpoint. Risk-reward ratio 2.17. Price breaks away from the 0.33 stack. It moves lower. The trail is available. July 16th US gives a short from the retest. Entry. July 10th US upper boundary. Stop. July 15th US lower boundary. Target. July 16th US midpoint. Risk-reward ratio 1.89. Price returns to the same stacked line. It fails. The target is the active midpoint. Different trigger. Same method. One trade breaks down. One trade rejects the retest. Both require the same question. Where is the stop? Where is the entry? Where is the target? Does the ratio stay above 1.5? Does price reach the line? Does price fail or hold? Then the trade opens. Now trader type matters. An aggressive trader may tighten the stop above the failed 0.33 retest. The ratio improves. Position size can increase. Sometimes that works. Price rejects quickly. The short reaches the midpoint. But stacked memory can whip. Price can move slightly above the line. A tight stop can get touched. Then, price can still fall. The idea was right. The position is gone. A conservative trader respects July 15th US lower boundary. Position size becomes smaller. The trade survives more noise. But the target is only the July 16th midpoint. So the stop cannot be widened blindly. If the stop becomes too wide, the 1.89 setup weakens fast. The trade must stay clean. No trailing target is used here. That matters. The target is the midpoint. The job is simple. Enter near failed stacked memory. Exit near the active midpoint. If the midpoint does not arrive, protect. If the retest reclaims, leave. If the session keeps rotating, wait. Now final read. July 16th US session forms between July 14th US midpoint and July 10th US midpoint. Price rises. It tests July 10th US upper boundary. That same line is June 22nd US lower boundary. That same line is weekly 0.33. Price cannot stay there. The short opens. Entry: July 10th U.S. upper boundary. Stop: July 15th U.S. lower boundary. Target: July 16th U.S. midpoint. Risk-reward ratio: 1.89. Price reaches. It reacts. It fails to hold. Then the short earns the midpoint. Price falls through old memory, but it starts from a tight box. The session forms between July 16th U.S. midpoint and lower boundary. Before any 1-hour trade, the higher time frame comes first. Do not enter the chart blind. Look at the monthly chart. Look at the weekly chart. Look at the daily chart, especially the weekly chart. The weekly chart must stay in your head before the first entry line appears. The market is still trading around major pressure. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines are the field. They decide where 1-hour movement can survive. A session can compress, but compression does not give direction. A lower boundary can look weak, but it must break first. A short can look ready, but it needs the failed hold. Now look at July 16th Asia session. July 16th Asia session forms between July 16th U.S. session midpoint and July 16th U.S. session lower boundary. It compresses there. It overlaps there. The session forms inside the lower half of active U.S. memory. That matters. Price is not forming near the upper edge. It is not forming in open space. It is forming between the midpoint and lower boundary. The box is tight. The distance is short. The reaction can come faster. Continuation can fail earlier. When a session forms inside the lower half of old memory, the first question is control. Can price hold above the Asia lower boundary? Can buyers defend the compressed base? Can price reclaim the midpoint? If not, the short can open. After July 16th Asia session forms, price moves lower. It breaks below July 9th U.S. session upper boundary. That is the first old memory failure. Then price continues lower. It tries to test July 13th U.S. session upper boundary. The movement is not random. It moves from active compression into lower old U.S. memory. Location: July 16th Asia forms between July 16th U.S. midpoint and lower boundary. Reach: price works inside the compressed Asia box. Reaction: buyers cannot lift price back through the active midpoint. Failure: price breaks below July 9th U.S. upper memory. Return: price moves toward July 13th U.S. upper memory. Now the trade must be built in the correct order. Stop line first. Entry line second. Target line third. Most traders see the red candle. They sell anywhere. That is not the method. The short does not begin because the candle is red. The short begins when the lower boundary fails. If the stop line is not clear, no entry. If the target does not pay, no trade. If the entry comes after distance is gone, the trade becomes chase. For July 16th Asia session, the short setup appears. Short entry line. July 16th Asia session lower boundary. Stop loss line. July 16th Asia session upper boundary. First, take profit line. July 9th U.S. session upper boundary. First, trailing take profit line. July 13th U.S. session upper boundary. Risk-reward ratio 3.69. The entry sits at July 16th Asia session lower boundary. Why there? Because the Asia session forms compressed inside the lower half of July 16th U.S. memory. The lower boundary becomes the failure line. If price holds above that lower boundary, sellers do not have control. If price breaks below it and cannot reclaim, the compressed box loses support. That gives the short. The entry is not random. The entry is the failed lower side of the Asia box. Price reaches the lower boundary. It breaks. It tries to return. It cannot stay back inside. Distance opens lower. Then the short becomes active. The stop sits at July 16th Asia session upper boundary. Why there? Because the short depends on the Asia box failing from the lower side. If price returns through the box and reaches the upper boundary, the breakdown has failed. The market is not accepting the lower move. The short loses control. So the stop belongs at the Asia upper boundary, not inside random noise, not under fear, not at a candle that only feels safe. At the line where the idea breaks. If price reaches it, leave. No hope. No argument. No waiting for one more candle. The first target sits at July 9th U.S. session upper boundary. Why there? After the Asia lower boundary fails, price moves into old July 9th U.S. memory. July 9th U.S. upper boundary is the first working destination. It can react. It can slow the drop. It can make shorts protect profit. So the first target belongs there. Then the trade can trail toward July 13th U.S. session upper boundary. Why there? Because if price breaks below July 9th upper memory and cannot reclaim, the next lower old U.S. memory comes into play. July 13th U.S. upper boundary becomes the deeper target. But that target must be earned. Price must first reach July 9th U.S. upper boundary. It must fail to reclaim upward. Pullbacks must stay weak. Continuation must not fail early. Only then does the trail toward July 13th U.S. upper boundary become valid. Risk-reward ratio reaches 3.69. That is strong. But the number only works with clean execution. If entry comes late after price already drops toward July 9th U.S. upper boundary, the ratio weakens. If the stop is widened above July 16th Asia upper boundary, the ratio weakens. If the trader aims for July 13th U.S. upper boundary before the first target is earned, the trade becomes hope. The short must begin at the failed compressed lower boundary, not after the move becomes obvious. Now watch the behavior. Price breaks below July 9th U.S. upper memory. It cannot reclaim cleanly. Pullbacks stay heavy. Reaction from buyers comes too late. Continuation keeps pressing lower. The short gains pressure. But targets still matter. If price reaches July 9th, U.S. upper boundary and stalls, protect. If price breaks it and holds lower, trail. If price reaches July 13th U.S. upper boundary and reacts, protect again. Old memory can hit back at any moment. Do not freeze at the target. A target that moves without a stop is only hope. When the target moves, the stop must move too. A practical trailing interval needs about 0.5 risk-reward unit or more. Less than that becomes noise. If the stop trails too tight, normal reaction can touch it. The position disappears before the move finishes. If the stop stays too far behind, the trail protects nothing. So the stop follows structure. Not fear, not greed, not the last red candle. Now trader type matters. An aggressive trader may tighten the stop. The stop becomes smaller. Position size can become larger. Sometimes that works. Price never returns high enough to touch it. The short pays fast. But compressed boxes can whip. A candle can retest the broken lower boundary. A tight stop can get touched. Then, price can still fall. The idea was right. The position is gone. A conservative trader respects the July 16th Asia upper boundary. Position size becomes smaller. The trade survives more noise. But if the stop becomes wider, the target must still pay. A wide stop with the same target damages the ratio. So every line must be checked together. Stop, entry, target, risk, reward. Partial profit can help. A conservative trader can take 60% at the first target and leave 40% for the trail. An aggressive trader can take 40% first and leave 60% for continuation. For multiple stages, a conservative trader can take 50% first, then 30%, then 20%. A balanced trader can take 25% first, then 50%, then 25%. An aggressive trader can take 20% first, then 30%, then 50%. But the split does not create the edge. The edge comes from compressed lower memory failing. The edge comes from the stop protecting the Asia box. The edge comes from July 9th and July 13th U.S. memory giving target distance. July 16th Asia gives the first message. The session forms between July 16th U.S. midpoint and lower boundary. The box compresses. Price cannot hold the lower side. It breaks July 9th U.S. upper memory. It moves toward July 13th U.S. upper memory. Entry. July 16th Asia lower boundary. Stop. July 16th Asia upper boundary. Target. July 9th U.S. upper boundary. Trail. July 13th U.S. upper boundary. Risk-reward ratio. 3.69. Price reaches. It reacts. It fails higher. Then the short earns execution. Price bounces back. But the week is almost over. The session forms inside July 9th U.S. memory. Before reading July 17th U.S. session, keep the higher time frame visible. The weekly chart is still active. June 1st weekly basis box lower boundary. June 1st weekly basis box midpoint. June 1st weekly basis box upper boundary. May 1st weekly basis box lower boundary. May 1st weekly basis box upper boundary. April 1st weekly basis box lower boundary. March 1st weekly basis box lower boundary. February 1st weekly basis box lower boundary. February 1st weekly basis box upper boundary. Weekly 0.5. Weekly 0.33. Weekly 0.25. February 5th key low. June 30th key low. The falling trend line. The rising trend line. Those lines still shape the 1-hour chart. The prior Asia short already moved lower, but the next U.S. session does not need to stay short. Price can bounce. It can reclaim part of the drop. It can move back into the active box. But a bounce near the final session is dangerous. The chart can give a setup. The calendar can still reject execution. Now look at July 17th U.S. session. July 17th U.S. session forms inside July 9th U.S. session box. It overlaps there. The session forms inside old U.S. memory. That matters. The new U.S. box does not form in clean space. It forms inside a prior U.S. range. The market is already rotating through old lines. Distance is not wide. Reaction can come quickly. Continuation can fail earlier. After July 17th U.S. session forms, price moves higher. It breaks above July 16th U.S. session lower boundary. Then it moves higher again. It tests July 16th U.S. session midpoint. The bounce is visible. Buyers reclaim the lower boundary. They push toward the midpoint. But the target is not far, and the session is the last U.S. session of the week. That changes the decision. Location. July 17th U.S. forms inside July 9th U.S. memory. Reach. Price moves above July 16th U.S. lower boundary. Reaction. Sellers try to slow the bounce. Failure. The lower breakdown cannot continue. Return. Price moves toward July 16th U.S. midpoint. Now build the long plan. Stop line first. Entry line second. Target line third. For July 17th U.S. session, the long setup appears. Long entry line. July 17th U.S. session upper boundary. Stop loss line. July 17th U.S. session lower boundary. Take profit line. July 16th U.S. session midpoint. Risk-reward ratio 1.56. The entry sits at July 17th U.S. session upper boundary. Why there? Because the session forms inside July 9th U.S. memory. The upper boundary becomes the confirmation line. If price breaks above the July 17th U.S. upper boundary and holds, the bounce has reclaimed the active box. That gives the long. The entry is not the first green candle. The entry is the hold above the active U.S. upper boundary. Price reaches the upper area. It must hold. It must keep distance. It must not fall back into the box. Only then does the long become possible. The stop sits at July 17th U.S. session lower boundary. Why there? Because the long depends on the July 17th U.S. box holding after breakout. If price falls back through the box and reaches the lower boundary, the reclaim has failed. The market is not accepting the bounce. The long loses control. So the stop belongs at the July 17th U.S. lower boundary. Not under a random wick. Not inside the middle. At the line where the idea breaks. If price reaches it, leave. No hope. No argument. No waiting for another candle. The target sits at July 16th U.S. session midpoint. Why there? After July 17th U.S. upper boundary holds, price moves toward the next old control line. July 16th U.S. midpoint is the first working destination. It can react. It can reject. It can stop the bounce. So the target is structural. Risk-reward ratio reaches 1.56. It barely passes the filter. That matters. A 1.56 trade has almost no room for mistake. A late entry breaks the math. A wider stop breaks the math. A slow final session breaks the timing. The plan is clean enough on paper, but the session context is weak. It is the final U.S. session of the week. Final sessions can trap. Targets can remain unfinished. Liquidity can thin. Weekend risk can distort the next open. The trade may exist, but the better execution can still be skip. That is the key lesson. A setup above 1.5 does not force a position. A valid entry line does not force a trade. A bounce into the midpoint does not force the account to take weekend risk. The method opens trades, but it also blocks trades. The account survives because it can say no. Now watch the behavior. Price reclaims July 16th U.S. lower boundary. It pushes toward July 16th U.S. midpoint. The bounce works, but the distance is short. The target is close. Reaction can return quickly. Continuation does not have wide space. If you enter late, the whole trade becomes fragile. If you hold past the session because you want more, the risk changes. The market is not offering a large, clean route. It is offering a final session bounce inside old memory. That is not the best place to force size. Now compare the two structures. July 16th Asia gives a stronger short. Entry. July 16th Asia lower boundary. Stop. July 16th Asia upper boundary. Target. July 9th U.S. upper boundary. Trail. July 13th U.S. upper boundary. Risk-reward ratio 3.69. That trade has better distance. It starts from compression failure. It moves into old memory below. July 17th U.S. gives a long plan. Entry. July 17th U.S. upper boundary. Stop. July 17th U.S. lower boundary. Target. July 16th U.S. midpoint. Risk-reward ratio. 1.56. The setup barely passes. The session is late. The week is ending. The cleaner decision is skip. No trade is not fear. No trade is risk control. A trader who only wants action takes every small edge. A trader who wants survival filters the final session. The market will open again. Another Asia session will form. Another US box will appear. Another line will give cleaner distance. But the account must still be there. Now trader type matters. An aggressive trader may still take the long. The stop is clear. The target is clear. The ratio is above 1.5. Sometimes that works. Price reaches the midpoint. The trade pays. But if reaction comes back fast, the late long gets trapped. If the target stalls, the trader faces weekend pressure. If the stop is hit, the small edge disappears quickly. A conservative trader skips. That protects capital. That protects focus. That protects the next week. No position means no weekend stress. No weekend stress means cleaner execution later. That matters more than catching every bounce. There is no trailing here. The target is only July 16th U.S. midpoint. The job is simple. If the trade is taken, enter only near July 17th U.S. upper boundary. Stop at July 17th U.S. lower boundary. Take profit at July 16th U.S. midpoint. Do not widen. Do not chase. Do not carry hope. If price does not move quickly, protect. If price returns inside the box, reduce. If price reaches the lower boundary, exit. But the preferred action remains skip, because the final U.S. session does not need to be traded. Now, final read. July 17th U.S. session forms inside July 9th U.S. memory. Price rises. It breaks above July 16th U.S. lower boundary. It tests July 16th U.S. midpoint. The long plan appears. Entry. July 17th U.S. upper boundary. Stop. July 17th U.S. lower boundary. Target. July 16th U.S. midpoint. Risk-reward ratio. 1.56. But it is the final U.S. session of the week. The better trade is no trade. Price reaches. It reacts. It offers little distance. Then the account waits. The 1-hour chart keeps flipping, but the bigger chart keeps the trap in place. The next map forms through daily, weekly, and monthly memory. Now step back from the 1-hour chart. The session trades already showed the week. Compression broke down. Targets stalled. A huge long launched from a lower base. A clean plan missed entry. Weekly 0.33 rejected again. The final session offered a week long. The account waited. That is not random. The 1-hour chart is only the execution layer. The daily chart gives the route. The weekly chart gives the battlefield. The monthly chart gives the risk. Do not reverse the order. If you start from the 1-hour chart alone, every move feels urgent. A red candle pulls you into a short. A green candle pulls you into a long. A missed entry feels painful. A stopped move feels personal. But the larger chart removes that noise. It tells you where the session has room. It tells you where the target can pay. It tells you where the trap is likely to form. This week, price kept moving around old U.S. memory. But the deeper pressure came from the larger time frame. Daily structure kept price near the July daily field. Weekly structure kept price around 0.33. Monthly structure kept the market under higher memory while it reacted from lower zones. That is why the 1-hour trades did not move smoothly. Price dropped from compression. Then it stalled. Price launched from compression. Then it ran hard. Price reached weekly 0.33. Then it failed again. Price bounced late in the week. Then the setup had to be skipped. The bigger chart explains the pressure. It does not replace execution. The session still gives the entry. But the higher time frame tells you whether the entry deserves trust. Now the daily chart comes first. The daily chart shows where this week's 1-hour movement sits. Daily candles are not moving in empty space. They are moving between old, lower recovery memory and weekly pressure. If daily price holds above the July daily support area, 1-hour longs can work. But only from defended session lines. If daily price reaches weekly 0.33 and cannot stay, 1-hour shorts can return. But only from failed reclaim. If daily candles stay trapped between those lines, both sides become harder. Distance becomes shorter. Reaction comes faster. Continuation fails earlier. That is when the account waits. The daily chart gives root, not entry. The weekly chart matters more for next week. Weekly 0.33 kept appearing in the 1-hour chart again and again. July 14th, Asia formed at the stack. July 15th, Asia failed from the stack. July 16th, US retested the stack. That same area carried July 10th US upper boundary. It carried June 22nd US lower boundary. It carried weekly 0.33. Price kept reaching it. It kept reacting. It could not stay free. That is the weekly trap. Next week, remember that line first. If price reclaims weekly 0.33 and holds, the long side can improve. But the hold must appear. Not a touch. Not a wick. Not one fast candle. A session must form above it. Pullbacks must stay shallow. Continuation must not fail early. If price reaches weekly 0.33 again and fails, the short side can return. But the entry must come near the failed line. Not after price already drops into the middle. If distance is gone, the trade is gone. If price loses lower memory and cannot reclaim, shorts can extend. But lower key areas can still react. So do not chase the low. Wait for the failed reclaim. Wait for the next session. Wait for risk-reward. The monthly chart gives slower pressure. It does not change every hour, but it affects every hour. The market is still moving under major higher time frame memory. The bounce can work, but it has to prove survival. A green candle does not give freedom. A weekly reclaim does not matter unless it holds. A 1-hour breakout does not matter unless it leaves the old box behind. That is why the monthly chart must stay in the background. It keeps the trader from trusting every bounce too early. It also keeps the trader from shorting too late near lower memory. The full process is simple. First, locate the monthly risk. Then locate the weekly battlefield. Then locate the daily route. Then return to the 1-hour session. Ask the same questions. Where did the session form? Did it form inside old memory? Did it form at the boundary? Did it compress? Did it expand? Did price reach the boundary? Did it hold? Did it fail? Did distance open? Did reaction come faster? Did continuation fail earlier? Does risk-reward stay above 1.5? If yes, execute. If no, wait. This is how the next 3 charts must be used. Not as a recap. Not as background. Not as decoration. They are the map for the next trade. The daily chart shows why the week kept moving between recovery and pressure. The weekly chart shows why 0.33 kept rejecting freedom. The monthly chart shows why the bounce still needs proof. Then next week begins the same way. A session forms. Price reaches. It reacts. It holds or fails. Then the trade begins. Or the account waits. #pot 8 ilbong. Price rises from the key low. But it still cannot leave weekly 0.33. The daily session forms near February 5th memory. Look at the daily chart. July 1st daily basis candle forms near the February 5th key low. Price was already deep. It had already reached lower memory. It had already moved into the area where reactions can come fast. But the first bounce does not give freedom. A green daily candle does not give permission. A move away from the low still has to hold. After July 1st daily basis candle forms, price moves higher. It breaks above the July 1st daily basis candle. Then price moves toward weekly 0.33. It tests that line. The bounce looks strong. But weekly 0.33 is still above. That line keeps pulling price into a decision. Price reaches it. It reacts. It cannot leave cleanly. Then the 1-hour chart starts to fight inside the same pressure. After price breaks the July 1st daily basis candle, the daily candles move between two key areas. Below the July 1st daily basis upper boundary. Above weekly 0.33. That is the daily field now. Not open space. Not clean trend. A narrow fight between daily recovery and weekly pressure. The candles move higher. Then they stall. They pull back. Then they rise again. The distance is not wide. The reaction comes sooner. Continuation fails earlier near the upper side. That is why the 1-hour chart kept changing direction. A session breaks down. Then the next session launches. A short pays. Then a long pays more. A plan appears. Then entry is missed. A retest reaches weekly 0.33. Then it fails again. The daily chart holds the reason. Price is trading between the July daily upper boundary and weekly 0.33. When price is near the lower side, longs can appear, but only if the session holds. When price is near weekly 0.33, shorts can appear, but only if the reclaim fails. When price stays in the middle, the account waits. That is how we adapt. We do not choose one direction for the whole week. We react to the daily field. Then, we execute from the session box. Now look at the lower side. July 1st daily basis candle forms near the February 5th key low. That lower memory creates reaction. Price cannot keep falling there. It starts to recover. But the recovery needs structure. The 1-hour chart must give a base. The session must form at or inside old memory. Price must reach the lower boundary. It must react. It must hold. Then the long can open. That is what happened with the stronger long. July 13th Asia forms compressed inside July 8th US memory. Price holds the lower side. It cannot continue lower. Then it launches. That daily bounce becomes a 1-hour execution. Entry comes from the session lower boundary. Stop protects the parent memory. Targets move through old US lines. The daily chart gives the route. The 1-hour chart gives the trigger. Now look at the upper side. Weekly 0.33 waits above the daily candles. Price reaches that area more than once. It cannot move free. It reacts. It returns. That pressure creates short setups. But the short still needs proof. A touch of weekly 0.33 is not enough. A red candle is not enough. The session must fail. The line must reject. Price must lose distance. Then the short can open. That is what happened around the stacked 0.33 area. July 14th Asia forms at July 10th US upper boundary. That same area overlaps June 22nd US lower boundary. It also sits near weekly 0.33. Price stays inside the box. No entry. No trade. Then July 15th, Asia forms at the same stacked zone. Price cannot stay above it. It breaks lower. The short opens. The difference is not opinion. The difference is behavior. One session stays trapped. The next session fails the line. One account waits. The next account executes. That is the method. Now look at the daily candles again. They are not moving randomly. They are moving around key locations. February 5th key low below. July 1st daily basis upper boundary under the current candles. Weekly 0.33 above. The rising trend line below still reacts. The falling trend line above still presses. The orange moving average above still slopes down. The daily chart is not giving full freedom. It is giving pressure from both sides. That pressure explains the 1-hour rhythm. When price drops into lower daily memory, the short becomes dangerous if it is late. Reaction can come fast. When price rises into weekly 0.33, the long becomes dangerous if it is late. Rejection can come fast. So the trade has to start at the session line, not after the daily candle already moved. This week proves that. July 12th Asia gives a 4.28 short. It starts from compressed memory. It works because the upper side fails. July 13th US gives a 1.99 short. It moves lower, but the full target does not arrive. Price stalls. Small profit protects the account. July 13th Asia gives the 9.25 long. It starts from a compressed base. The move expands. The daily recovery has room, but only because the entry starts low. July 14th US gives a 2.01 long plan. Price moves without touching entry. No entry. No chase. July 14th Asia gives a 2.83 short plan near weekly 0.33. Entry does not come. The box does not release. No trade. July 15th US gives a 3.13 short. Compression fails from upper memory. The short earns execution. July 15th Asia gives a 2.17 short. Weekly 0.33 fails again. Price leaves the stacked line. July 16th US gives a 1.89 short. The bounce retests weekly 0.33. It cannot stay. The short takes the midpoint. July 16th Asia gives a 3.69 short. The lower side fails. Price moves toward older US memory. July 17th US gives a 1.56 long plan. The week is almost over. Distance is short. The better trade is skip. Now the daily chart becomes clear. The week did not move because one side controlled everything. It moved because price was trapped between daily recovery and weekly 0.33. Every session had to prove itself. Every trade had to pass the same filter. Stop line first. Entry line second. Target line third. If the stop is too far, the trade weakens. If the entry is late, the trade dies. If the target is too close, the account waits. If the session stays inside the box, no trade. If price touches nothing, no entry. If the final US session gives a weak ratio, skip. That is how the daily chart becomes a trading map. It does not tell us to buy everything. It does not tell us to short everything. It tells us where pressure lives. Below, July daily upper boundary must hold for buyers. Above, weekly 0.33 must break and hold for recovery. If price stays between them, 1-hour trades need precision. If price holds the lower daily boundary, long setups can appear, but only from a defended session line. If price reaches weekly 0.33 and cannot stay, short setups can appear, but only from a failed reclaim. If price breaks above weekly 0.33 and holds there, the next long side can improve. But holding must appear. A wick does not count. A fast candle does not count. A session must form above it. pullbacks must stay shallow. Continuation must not fail early. If price loses the July daily upper boundary, the bounce weakens. Then price can return toward the lower daily field. February 5th kilo and June 30th kilo can come back into focus. But even there, no chase. Price must reach. It must react. It must hold or fail. Then the session decides. Now look at the daily chart one more time. Do you see the candles moving near the major lines? Do you see why the 1-hour chart kept switching? Do you see why the strategy could not stay only long? Do you see why the strategy could not stay only short? The daily chart made the pressure visible. The session chart made the execution possible. Price rises from February 5th memory. It tests weekly 0.33. It moves between July daily upper boundary and weekly 0.33. The field stays tight. Reaction comes faster. Continuation fails earlier. Then the trader adapts. Long at the hold. Short at the failure. Skip in the middle. Price reaches. It reacts. It holds or fails. Then the trade begins. Or the account waits. Price keeps testing the same weekly trap. But it still cannot leave the box. The weekly session forms inside June memory. Look at the weekly chart. July 1st weekly basis box forms between the June weekly lower boundary and the June weekly midpoint. It compresses to about 25%. It overlaps inside the June weekly box. Price does not open in free space. It forms inside older pressure. That location matters. Below, February 5th key low waits. Above, weekly 0.33 waits. Price forms between them. Then price keeps moving inside the July weekly box. It reaches the lower side. It reacts. It tests the June monthly low. It tests weekly 0.25. Then it returns upward. It reaches the upper side. It reacts. It tests weekly 0.33. Then it cannot leave cleanly. That is why the 1-hour chart kept changing direction. The lower side gives reaction. The upper side gives rejection. The middle gives friction. When price is near the lower side, shorts become dangerous if they come late. When price is near weekly 0.33, longs become dangerous if they come late. The weekly chart forces adaptation. Not one bias. Not one direction. Line by line. Session by session. Now watch the trendline field. From February, price moved between the first falling trend line and the second falling trend line. It reached one side. It reacted. It reached the other side. It reacted again. Then April pushed upward. Price broke out of the first falling trend line field. But the move still did not become free. After April, price moved between the second falling trend line and the third falling trend line. It stayed trapped there. It moved sideways there. It kept reacting inside that space. So price escaped one pressure field. Then it entered the next pressure field. That is why the bounce can look strong. But it still fails near upper memory. That is why the drop can look weak. But it still reacts near lower memory. The falling trend lines spread with similar distance. The rising trend lines also spread with similar distance. Price moves between those lines. It reaches. It reacts. It cannot continue cleanly. It returns. That rhythm matters. The trend lines are not decoration. They create the pressure path. They help explain why continuation fails early. They help explain why distance becomes shorter near the edges. They help explain why reaction speeds up after the reach. Now look at the weekly basis boxes. March 1st weekly basis box forms inside February 1st weekly basis box. It compresses there. Price cannot leave February memory. April 1st weekly basis box forms inside March 1st weekly basis box. It compresses again. Distance becomes shorter. Reaction comes sooner. Continuation fails earlier. May 1st weekly basis box forms near the upper side of February 1st weekly basis box. It compresses again near upper memory. Price reaches higher, but it cannot open free space. Then June 1st weekly basis box expands inside February 1st weekly basis box. Compression releases. Range opens. Movement becomes wider. But even that expansion stays inside February memory. Then July 1st weekly basis box forms inside June 1st weekly basis box. It compresses again. That is the key change. June expands. July compresses. June opens distance. July reduces distance. June gives movement. July gives the trap. So next week cannot be read as a clean breakout yet. Price is still inside the July weekly box. Price is still between February 5th kilo and weekly 0.33. Price is still trapped between falling trendline pressure and rising trendline reaction. That is the weekly battlefield. Now connected to the week. July 12th Asia short starts from compression. Price forms inside June 18th US memory. The upper side fails. Distance opens lower. The short pays. July 13th US short starts with a valid plan, but continuation slows. Target does not fully arrive. Small profit protects the account. July 13th Asia long starts from a compressed base. The lower side holds. Price launches. Distance opens wide. The 9.25 long works because entry starts near the base, not after the breakout becomes obvious. July 14th US gives a long plan, but price does not touch the entry line. No entry. July 14th Asia forms around weekly 0.33. Price stays trapped. No entry. No target. No trade. July 15th US gives the short. The upper side fails. Price moves lower. The 3.13 short works. July 15th Asia returns to the stacked line. June 22nd US lower boundary. July 10th US upper boundary. Weekly 0.33. Price cannot stay above it. The short opens. July 16th US retests the same stack. Price reaches weekly 0.33 again. It cannot stay. The short takes the midpoint. July 16th Asia compresses inside lower memory. The lower side fails. The 3.69 short opens. July 17th US gives a long plan, but it is the final US session of the week. Risk-reward is only 1.56. Distance is short. The better trade is skip. Now the weekly chart explains the whole sequence. Price was not trending cleanly. Price was rotating inside weekly memory. Lower memory gave reaction. Upper memory gave rejection. Compressed boxes created strong moves only when the boundary failed or held cleanly. That is why the method stayed the same. Stop line first. Entry line second. Target line third. If price forms near lower weekly memory, do not short late. Wait for the session to fail upward before shorting, or wait for the lower line to hold before studying along. If price forms near weekly 0.33, do not buy late. Wait for a real reclaim. A touch is not enough. A wick is not enough. A fast candle is not enough. The session must form above it. Pullbacks must stay shallow. Continuation must not fail early. If price reaches weekly 0.33 and cannot stay, the short side can return. But only from failed holding, not from chasing after the move already drops. If price drops toward February 5th kilo, June 30th kilo, or weekly 0.25, reaction can come fast. But a long still needs proof. The session must hold. The stop must be clear. The target must pay. If those are missing, the account waits. Now define the next test zones. Below, February 5th key low. Below that, June 30th key low. Below that, weekly 0.25. Those are the lower reaction lines. If price reaches them and cannot stay below, longs can appear, but only through session confirmation. Above, July weekly upper boundary. Above that, June weekly midpoint. Above that, weekly 0.33. Those are the upper pressure lines. If price reaches them and cannot stay above, shorts can appear, but only from failed reclaim. If price breaks above weekly 0.33 and holds, the field changes. The long side gets more room, but the hold must appear. If price breaks below weekly 0.25 and cannot reclaim, lower pressure opens. But do not chase the breakdown late. Wait for the failed reclaim. Wait for distance. Wait for risk-reward. That is the weekly plan. The 1-hour chart gives entry. The weekly chart gives the battlefield. The account survives only when both agree. July 1st weekly basis box compresses inside June. Price tests weekly 0.25 below. Price tests weekly 0.33 above. The trap remains active. Price reaches. It reacts. It holds or fails. Then the trade begins, or the account waits. Price is bouncing from the lower monthly field, but the upper line still rejects freedom. The monthly session forms between weekly 0.25 and weekly 0.33. Look at the monthly chart. July monthly candle is testing the June monthly low. It is also testing weekly 0.25 below. That lower line is close. Price is not far from danger. It is reacting from the lower monthly area, but it has not escaped yet. Above, July is testing weekly 0.33. That upper line keeps pressure on the bounce. So July is caught between two major forces. Below, June low and weekly 0.25. Above, weekly 0.33. That is why July does not move cleanly. It pushes up. It reacts. It pulls back. It tries again. It still has to prove holding. The candle is green now. But green does not give freedom. A monthly green candle near lower memory still needs proof. It must stay above the June low. It must stay above weekly 0.25. It must keep pressure toward weekly 0.33. If it cannot do that, the bounce weakens. If it can do that, the 1-hour long side can keep appearing. But the session still decides entry. No monthly candle gives a blind trade. The 1-hour line still has to hold. Now look at June. June monthly candle tested the February monthly low. It also tested weekly 0.25. Price reached the lower field. It reacted. It could not continue straight lower. That reaction created the room for July. But it did not remove the risk. June left price near lower memory. July started from that pressure. So every July recovery has to fight. It can move. It can bounce. It can even break 1-hour boxes. But it cannot be trusted without holding. That is why this week had both strong longs and clean shorts. The monthly chart gave reaction below. The weekly chart gave pressure above. The 1-hour chart had to trade between them. Now look at May. May monthly candle tested the lower boundary of the 2026 monthly basis box. That area also connects with the weekly 0.55 zone. Price reached it. It could not stay. It failed there. Then the market returned lower. That failure still matters. May tried to reclaim higher monthly memory. It failed. June carried the failure downward. July is now trying to recover from the lower side. So the sequence is clear. May reaches higher memory. It fails. June returns lower. It tests February low and weekly 0.25. July reacts. It tests weekly 0.33. The movement is not random. It is a chain of failed holds and returns. April also matters. April monthly candle formed between 0.33 and 0.5. It stayed inside that zone. It did not open clean upside. It did not reclaim higher memory. It formed between ratio pressure. Then May pushed higher and failed. Then June dropped lower. Then July reacted from the lower field. The monthly rhythm keeps repeating. Reach, react, fail, return. Then the next candle tests the next memory. March gave the upper wick. That wick was fully checked. Price reached that upper area. It could not stay. The wick stayed active as pressure. Then price overlapped the decline from February. That is important. The market did not leave the February drop behind. It returned into it. It overlapped it. It traded inside that memory. So the February decline still shapes the current month. The July bounce is happening inside the shadow of the February drop. That is why the bounce needs proof, not hope. Not one candle. Proof. Now remember the yearly structure. The 2026 first monthly basis box formed at the lower side of the 2025 first monthly basis box. It overlapped there. Price did not begin the year above old strength. It began at the lower side of older yearly memory. That keeps pressure on every rally. When price tries to recover, it runs into old yearly memory. When price falls, it returns toward lower monthly memory. That is why the market keeps moving like this. Strong movement appears. Then holding fails. Reaction comes back. Distance shrinks again. Now connect the monthly chart to this week. July 12th Asia gave a 4.28 short. Price formed inside old US memory. Compression failed. Distance opened lower. That short worked because the higher field still had pressure above. July 13th US gave a short with 1.99 risk-reward. The move worked only partly. The target did not fully arrive. The account protected small profit. That fits the monthly field. The market was not in clean downside expansion. It was still reacting from lower monthly memory. Then, July 13th, Asia launched. The session formed compressed inside July 8th US memory. The lower side held. Price pushed hard. The 9.25 long opened from the base. That move fits the monthly bounce from the lower zone. But it still needed the 1-hour line. The monthly chart gave room. The session gave entry. July 14th US gave a long plan. Price moved higher, but it never touched the entry line. No entry. That also fits the monthly field. A bounce can move without giving clean risk. We do not chase it. July 14th Asia formed near weekly 0.33. The short plan appeared. But entry did not come. Price stayed trapped. No trade. That fits the monthly pressure above. July 15th US gave a 3.13 short. The upper side failed. Price moved lower. That was reaction from upper memory. July 15th Asia failed from the 0.33 stack. The short opened. July 16th US retested weekly 0.33. It could not stay. The short took the midpoint. July 16th Asia compressed lower. The short opened again with 3.69 risk-reward. Then July 17th US gave a 1.56 long plan. But it was the final US session. The better trade was skip. The monthly chart supports that choice. July is still between lower defense and upper pressure. The week is ending. Distance is short. The account waits. Now build the next monthly plan. First, watch the lower side. June monthly low, weekly 0.25. February monthly low, February 5th key low, June 30th key low. If price drops into those areas and cannot stay below, reaction longs can appear. But the entry still comes from the session. The session must form at or inside old memory. Price must reach the lower boundary. It must react. It must hold. Then the long can open. If price breaks below weekly 0.25 and cannot reclaim, the long side weakens. Then lower pressure can return. But do not chase late. Lower monthly memory can still react. Wait for failed reclaim. Wait for distance. Wait for risk-reward. Now watch the upper side. Weekly 0.33. Monthly 0.33. The April range. The lower boundary of the 2026 monthly basis box. The weekly 0.55 area above. If price reaches those lines and cannot stay, shorts can appear. But the short must start near failure, not after price has already dropped. If distance is gone, the trade is gone. If the stop becomes too wide, the trade weakens. If the target does not pay above 1.5, the account waits. If July breaks above weekly 0.33 and holds, the field can improve. But holding must appear. A wick does not count. A fast candle does not count. A 1-hour spike does not count. The session must form above the line. Pullbacks must stay shallow. Continuation must not fail early. Then the long side can get more room. Until then, weekly 0.33 remains pressure. Now look at July again. Below, it tests June low and weekly 0.25. Above, it tests weekly 0.33. That is the whole monthly fight. The candle can be green, but it still trades inside pressure. The bounce can look strong, but it still needs proof. The short can look tempting, but lower memory can still react. So the trader does not choose emotion. The trader chooses the line. Monthly gives risk. Weekly gives battlefield. Daily gives route. Session gives execution. Do not mix them. Do not trade the monthly candle directly from the 1-hour chart. Use the monthly chart to know where danger sits. Use the weekly chart to know where the trap sits. Use the daily chart to know where price is traveling. Use the session box to decide entry, stop, and target. That is how the whole week connects. The monthly chart explains why July keeps reacting. The weekly chart explains why 0.33 keeps rejecting. The daily chart explains why candles move between recovery and pressure. The 1-hour chart gives the trades. Now the final frame is simple. If July holds above the June low and weekly 0.25, the bounce can continue. If July keeps failing under weekly 0.33, shorts can return. If price stays between them, the market stays trapped. Then risk must shrink. Entries must be cleaner. Late trades must be skipped. Final session trades must be filtered harder. That is the lesson from this week. July reaches lower monthly memory. It reacts. It tests weekly 0.33. It cannot leave yet. The next trade does not come from prediction. It comes from the next session line. Price reaches. It reacts. It holds or fails. Then the trade begins, or the account waits.